We are joined by Alan Greenspan, who has had a few jobs in his career, but one of the most notable was the president of the National Association for Business Economics back in the 1960s. Today they gave you the Paul Volcker Award for Lifetime Achievement. What's changed from when you were a young person in this organization and the economic world that we see today? Your cell phone. Yeah.
But what it represents, the state of knowledge of what is going on in the world is so much enhanced since those early days. And the ability to understand the interrelationships is much greater, plus the extraordinary improvement in technical capabilities of processing data. And it makes a huge difference. I mean, it's very important to know what you're talking about. And the more information you have, and that is basically the major advance that affects all of us who are in the forecasting business. And that includes central bankers, business executives of major corporations. We're all looking at the same phenomenon. And the more we know, the better we are.
Well, the Fed, you mentioned, is now in the process of a year-long review of its regimes, its policies, and its communications. If you were still in charge, how would you change it? Do you think it works well, or are there things that would make it smoother, that would make monetary policy easier?
I assume the judgment of the Federal Open Market Committee will reign above all.
Well, they've made no decisions. Do you like the new communications regime where we have a press conference after every meeting? So much is released publicly. You started that in 1994. Are we better off for that now?
I just assume not to comment on what any of my successors did, because I so thought it was useful on my part when Paul Volcker for 18 years never once second-guessed what we were doing. And I thought that was very thoughtful of him. And I've essentially been trying as best I can to maintain it.
All right, well, let's shift gears to your own forecasts and your own outlook. You told the members of the organization here today that the longer run outlook is not so great. The short run outlook, though, may be better for the economy than people think.
Well, I'm merely saying that today's figures, for example, were a good deal better than a lot of people were forecasting. And I think what it is, and I think most economists would agree, is that the tax cut and the impact on capital investment has actually moved the system. Productivity growth had been a little over 1% for a goodly number of years. Now, we're not coming out of that particularly, but the latest data were not too bad on productivity, somewhat better than I would have assumed. And it's essentially the result, I think, of the tax cut. And how long it'll last, I do not know.
You mentioned the long term, and the long term for the United States involves very large budget deficits. When you were in office, and I was covering you then, you would talk about the fact that budget deficits are a danger, that we could see crowding out. Since then, we have massively larger deficits, but we don't see interest rates move. Have we discovered something different about the way deficits affect the economy or the appetite for U.S. treasuries?
No, it's a very interesting question. And where it shows up very specifically is a slowdown in turnover of the capital stock. We don't know why it is happening, at least I don't know why it's happening, but velocity is a very critical statistic in financial analysis, and it's not always easy to determine why it changed as it did. But what is happening now is it's changed, and we're getting a very considerable amount of potential inflationary I was about to say assets, some of them it's mainly debt. And we're running into what historically would be a stagflation, where we'd have both unemployment rise and inflation rise. We're getting neither of those two. And so that we have a system now which is really difficult to actually tie into the historical data very readily. I don't know what to say in what we should do about it, except to see if we can get better econometric models, which is essentially the way we make advances. Keynes, for example, in his 1936 famous book on money, developed a system which actually carried us from the dark ages of statistics into structural model building of cause and effect. Now, it's not turned out to be a flawless system by any means, but when you take, like, the Federal Reserve's got a very complex econometric model, which I found very useful in evaluating how the economy is behaving and how various different impacts on monetary policy from the economy would impact on our policy. And I thought that the knowledge that we picked up, that I picked up over the years while I was the Fed chairman, was instrumental in basically understanding how the system works. I think it was helpful in our performance, but history will say.
There is a theory out there, modern monetary theory, MMT, a lot of people are debating, that suggests that a country that prints money in its own currency doesn't have to worry about deficits as long as inflation isn't breaking out. If it does, the fiscal agent comes in and raises taxes. What do you think of that idea? Because it's being bruited as a way to spend more money on infrastructure, on the Green New Deal, things like that.
You have to shut down your foreign exchange markets. And how do you exchange stuff? People will be trying to fly out of your currency, and if there's no vehicle in which they can do it, it doesn't happen.
Now, inflation, the outlook for inflation, you did suggest that there is maybe something to be concerned about out there. One of the big debates at the Booth School Monetary Policy Conference last week was whether or not the Phillips curve is nonlinear, and we will suddenly see a breakout of inflation if unemployment continues to fall. Do you think that's the case?
I think the Phillips curve is misspecified. It shouldn't be unemployment, it should be unit labor cost. And so you can't really measure what the concept of is going to be unless you know what productivity is. I mean, I argued very strenuously in the latter months of 1990 that we needn't be concerned about the unemployment rate declining because we had a very significant rise in productivity, and that as we came down from, say, 6% unemployment down to 4% and lower, nothing happened. Why? Because unit labor costs didn't rise that much.
Before we let you go, I'm going to steal one more second here. You were a big baseball fan for years. The baseball season's about to begin. Any predictions?
Whatever team I vote for, by any measure, loses.